Singapore is one of the world's biggest economic miracles in the past few decades. Its economy grew from a struggling colonial trading post in the 1960s to a global financial and trade hub within a remarkably short period. One of the interesting facts about Singapore, however, is their national debt. Many Singaporeans know that Singapore has zero debt. They believe that their government does not borrow like many major economies out there, such as Japan, the United States, and many major European countries. Yet, if you take a look at the official data, it will show that Singapore actually has debt. Here's a graph with data that we gathered from the International Monetary Fund on the gross debt position as a percentage of GDP. What this data basically means is that it represents the total amount of debt Singapore owes as a percentage of its overall economic output, or gross domestic product. The IMF is a credible source, and, as you can already tell from the graph, Singapore's gross debt position is fairly big, with the latest year amounting to over 175%. A figure that is actually much higher than nearly every single nation out there. Comparatively, if you add the United States here, you'll even see just how big Singapore's gross debt is. Here's a ranking table of the largest holders of gross debt position as a percentage of GDP. As you can see, the top spot is Sudan, followed by Japan, and then the fourth spot is no other than Singapore. But as we mentioned earlier, many Singaporeans seem to misunderstand Singapore. They think that the country has zero debt. But that's actually not true. What is true is that Singapore has zero net debt. Here's a published article by ask.gov.sg, which is a Singapore government agency website. They said that the gross debt to GDP ratio is not an accurate representation of the Singapore government's financial position. Why? That's because it does not consider Singapore's strong reserve position. If you look at the second paragraph, you see that Singapore has indeed zero net debt, as the country has more assets than liabilities. What this basically means is that while Singapore has zero net debt, it does not mean it has zero debt. It does have debt, it's just that its assets are far more than its liabilities. But if we go by this standard, then a lot of countries globally don't really have a lot of debt. There's another data set in the IMF which shows the net debt as a percentage of GDP. Unlike gross debt position, net debt is when you subtract gross debt to the financial assets like gold, currency and deposits, SDRs, account receivables, and so on. For instance, Japan's gross debt has always been known to be over 250%. Yet, by the IMF's net debt data, it is just at 150%. This is the same for many major economies out there that you might think have large gross debt. One of the biggest questions that we need to answer after knowing that Singapore does have gross debt is how did Singapore even incur such big amounts of gross debt to begin with? Is it because the government borrowed heavily during the COVID-19 pandemic? Or is it because the Singaporean government needed to finance infrastructure projects? Well, these are all probable answers. But what we should know first is the general understanding of how governments borrow money. Let's take the example of Japan, which is a highly indebted nation. The Japanese government is one of the world's most indebted nations, and that is because they have been consistently spending more money than they earn. This explanation would be easier to understand if we take a look at the government budget of Japan. Here is the total account expenditure of Japan for 2024. As you can see, they are budgeting over 112 trillion Japanese yen, and they are going to spend that amount of money in different types, such as national defense, social security, and even national debt service. But to pay for this budget, they must generate revenue. And one of the ways the Japanese governments and many other governments around the world generate revenue is from taxes. Here's the graph for Japan's general account total revenue. And as you can see, over 61.8% of their total revenue will come from tax and stamp revenue. But if you take a look closer, you'll see that over 31.5% of their revenue is actually going to come from government bond issuances. This government bond issue basically means that Japan is relying on borrowed money to fund nearly a third of its annual budget. In other words, Japan doesn't have enough tax revenue to cover all of its government expenditures, so it resorts to borrowing by selling bonds to investors. Over time, as the government continues to borrow more, the total amount of outstanding debt accumulates, leading to a significant gross debt figure. So, how about Singapore? Does Singapore do the same thing? Their government, after all, also has a lot of expenditures. Well, to understand this, let's take a look at the government budget of Singapore. Here's a breakdown of the total expenditure by sector in Singapore for 2023. As you can see, they spend 49.7% of their total expenditure in social development, 20.4% for economic development, and the rest spread into two other sectors. In total, for 2023, their estimated expenditure is 104 billion Singaporean dollars. Now, unfortunately, the Ministry of Finance does not indicate whether they pay interest in their gross debt. But we'll talk more about that later on. For now, let's talk about how Singapore's government generates revenues. Here's a table on their operating revenues, and as you can see, a lot of it comes from corporate income tax, followed by personal income tax, and a long list of other taxes. However, as you can see, Singapore's government doesn't actually generate enough tax revenues. Their total revenues is only 96.7 billion Singaporean dollars, which is much less than their total expenditure for that 2023 year of over 104.86 billion Singaporean dollars. This is then what we call the primary deficit, as they are going to spend more money than they earn. This is how most governments go into debt, as they have to borrow money to cover that deficit. On top of that, the Singapore government also has other expenditures to take care of. The table of expenditures does not include special transfers and top-ups to their endowment and trust funds, which in 2023 is estimated to be billions of Singaporean dollars. That means their deficit is actually going to be worse. So, how is Singapore going to cover for this deficit? Well, it is through what they call the net investment returns contribution. This is a significant contributor as to why the Singaporean government does not borrow money for its budget. As the Singaporean government draws money on investment returns from its national reserves to fund its expenditures, they can draw up to 50% of the net investment income that is generated from past reserves, which includes interest and dividend income, and another up to 50% of the net investment returns, which comes from long-term expected real rates of return on reserves managed by the likes of GIC. These contributions then ensure that the government can sustain its operations and developmental plans without accumulating debt to cover deficits. Here's the overall table of all the expenditure and revenues of Singapore. As you can see, their overall fiscal position in 2023 is just a deficit of 350 million Singaporean dollars, which is very, very little as compared to its primary deficit of over $7.45 billion. So, why does Singapore have such big gross debt then? Is it not because of budget deficits? Well, it happens when they issue securities not to pay for immediate government operating expenses, but rather to facilitate other strategic financial goals. Unlike Japan, the United States, or various European countries, Singapore does not issue bonds to plug holes in its day-to-day budget. Instead, Singapore's government issues debt instruments for reasons linked to monetary policy operations, market development, and long-term asset management. For instance, one of their strategies is to cultivate a deep and liquid government bond market. Government bonds are often considered risk-free benchmarks within a country's financial ecosystem. Their yields help determine the cost of borrowing for everyone else: companies, financial institutions, and even individuals. By issuing a consistent stream of Singapore government securities, SGS, and related instruments, the government provides the backbone for its domestic financial markets. This, in turn, supports Singapore's broader ambition to be a global financial hub. Without these benchmark bonds, it would be difficult for other market participants to price corporate bonds, mortgage rates, and other debt instruments. In essence, government securities offer a reference point. By ensuring these securities are available, Singapore encourages more corporate bond issuances, more diversified investments, and a more stable financial landscape. Hence, the issuance of debt is not a sign of the government struggling to make ends meet, but a strategic tool to maintain an advanced and efficient financial market infrastructure. Then, when Singapore issues bonds, these funds are not funneled into covering overspending on social programs or infrastructure. Instead, the government transfers the proceeds into its reserves, managed by entities like GIC, Government of Singapore Investment Corporation. These institutions invest globally in a diversified portfolio of assets: stocks, bonds, real estate, private equity, infrastructure projects, and more. The idea is to earn a higher return on these investments than the interest Singapore pays on its bonds. And yes, Singapore still has to pay for their bonds, but the reason why it's not as big as it should be is because the returns are mostly higher than the interest itself. Finally, let's talk about how much debt Singapore really has, and then compare it to the assets and see just how zero its net debt is. Here's a table on the government debt of Singapore, data that we collected from SingStat. As you can see, the government debt of Singapore is over 1.2 trillion Singaporean dollars as of the latest quarter of 2024. And all of these are held domestically, with only a very tiny amount of it issued for spending purposes. Comparatively, before we talk about the assets, Singapore's GDP in Singaporean dollars from the same source is at $673 billion. So, how much are the assets of Singapore? Well, it's a mix of various sources, but one of them is Singapore's reserve assets, which amounts to over 503 billion Singaporean dollars. It can also come from Singapore's investment holdings and sovereign wealth funds, such as GIC, or even their overall international investment position. This money then shows just why Singapore has zero net debt, as they have more assets than liabilities. But anyway, do let us know what you think. Thanks for watching.